Thank you so much for joining in. And we have been having this very meaningful discussion all this while, especially in the context of so many new age technology companies that we are seeing going to public market float. What really have been the lessons learned, this transition from private markets to public markets. And now that we are getting towards the finale of this entire discussion today, I think it's sort of very moot and meaningful to really ask this question, that it's really not about the pop, like the way Kunal put it, or ringing that bell and making a big PR statement. You want to be doing this every day of the year. So the real journey for a company starts after the IPO. And I want to really begin the conversation with that narrative. A lot of adjectives sort of come to the fore, that you have to be anti-fragile, you have to be resilient, you have to be open to quarter scrutiny. But how many promoters in India are really sort of ready for that? Chakri, great to be connecting with you again. It's been after a while. But let me begin the conversation with you, Chakri. And you really have a finesse in especially the mid-market, small market space to what you do at TCG. How many promoters and entrepreneurs do you really think in India understand that the real game actually starts once you have crossed that IPO line? Yeah.
Hello, Surja. Nice to connect. And thanks for having me. And I think, India is at the cusp of phenomenal growth in the number of entrepreneurs and more evolved entrepreneurs in the current space. And I think, the business models also are the flow of ideas, versus 25 years ago when I started in this business to now, the flow of information is far faster. If something happens in the US, technology-wise, what happens or in any space for that matter, the flow of information to the other markets used to take far longer time. And so that faster movement of information can lead to more evolved business models being more evolved and localized or adapting to fast changing conditions. Now, I recall that, when I was in London and one of the anchor investors of Google many years ago, and at that time, when you had two phenomenally brilliant founders who decided just before the IPO that they were not the guys who are going to face the public markets. Yes, they were going to be involved in running the company, coming up with those ideas, innovations, but they were not going to be the front face of the company. And they hired Eric Schmidt, who did a phenomenal job in on one side, talking to the founders, on the other side, talking to the public markets. I think that realization is something which will happen over time. On the other hand, the flip side of this other example is, for example, Bill Gates or Mark Zuckerberg. These are not only brilliant founders, but they're also brilliant faces in communicating that message. It's a very different messaging when you're in a private company versus a public company. So I guess the founders of a business need to have that self-realization that, hey, you know what, I can be both, or I need to step back at some point. So I think, and as the business scales up, it depends upon where you are versus Facebook started off as a social platform for a university. From there, when it went to a global scale, the kind of reach, or rather the business model has to evolve. So it is that realization with both investors, whether, hey, does this founder have that to take the company to the next level and beyond, and for the promoter himself or herself to understand. I think that is a key for success.
Thanks for that, Chakri. That's very well put. I like the Google example, when the founders took this conscious decision that perhaps they are better at building the product and global domination for search engine, and perhaps the business side would really be very well enabling in the hindsight managed by Eric Schmidt. I also want to get you in, Rajan, in organizations which are going for public market float, how important it is for the founders to keep the ego apart. And are we really seeing that in promoters? I mean, what really do you think would be the lessons learned in those scenarios? Yeah.
Hi, Shrija. First of all, thank you for having us over here. And I would also like to begin by saying it's also nice to be on the same panel as Venkatraman, and he represents Happiest Minds. In fact, Happiest Minds was, although they're not a direct competitor for us, because when we went public or when we were hitting the markets, there was no direct competitor for us, and we had actually named Happiest Minds as one possible competitor for us, right? So it's nice to be on the same panel as Venkatraman. So coming to the question that you had, Shrija, specifically around how promoters should let go of their ego, right? Talking about just latent view, right? I mean, you would have seen that we had a phenomenal IPO. In fact, we set the record for the maximum number of oversubscription. We were oversubscribed about 338 times, right? Which was way past even our expectations. And clearly, in our case, I mean, although we're a company that provides new age digital services, we're essentially a 15-year-old company built on very solid foundations and very good corporate governance over time. The founders, Venkat and Pramad, in our case, they started this business, but effectively six years or 7 years into post starting the company, Venkat very quickly realized that he needs to bring in professional management to run the business. Right, they continue to be very closely involved in more strategic decision making and providing overall guidance. But effectively, the CEO is the captain of the ship. In our case, Mr. Rajan Sethuraman, who's the CEO of Latent View. He heads all aspects of the business, and me and him share a very close working relationship. The point that I'm trying to make is, you do have very nice examples of where, companies where promoters, once they've built a solid business, thereafter pass on the mantle to a professional management and let them run with it, right? In our case, pretty much the entire phase of the IPO, right from leading all the investor discussions, everything was done by the CEO and the CFO. And therefore, we could clearly see that the market also, right, they appreciate the fact that there's this very strong second layer management, or there's very strong management below the founders. And there is even though you can't put a value to it, I think market does, it does look for a very strong second layer management.
Thanks for that. I would like to sort of get Venkatraman here. Sort of a lot of admiration coming your way, Venkat, from Rajan, and especially for an organization which got subscribed to 338 times. From Happiest Minds perspective, I want to understand, Venkat, we spoke about the founder's ego, communicating to the external stakeholders that there is a very strong layer of second rung management which can take the company forward. What really are the pressures when you go public, really, when there's this innate realization that when you are private, perhaps investors are more forgiving, but now you've gone public, and that is when the game has begun. What really are the lessons there?
Shrija, thanks, and Rajan, thanks for your kind words. I would like to start with the premise. We, Happiest Minds, we started the company 10 years back, and in our vision statement, we said we would do a successful IPO. So we started the company on that basis. And if you look at our promoter, Ashok Soota, I was his first CFO at Mindtree. Before that, he was at Wipro. So I could say that we had a little bit of an experience with being public. But the fundamental point I would like to make is there is no difference in life between being private and public, because governance is philosophy. You can't change your value systems. For us, governance is part of our value system, and it's integral to who we are at Happiest Minds. So I'm not going to say that, life changes because I have to do a lot more disclosures when I'm a public limited company versus I'm private. Because for me, the money that we took from the PE participants or the VC participants is also money. We borrowed from banks. That's also money. Money is completely fungible, and it's owned by public at large. So if you look at what happened at PNB, for example, that's public money. How can you differentiate between PNB money and the public money? So to that extent, we treated investors, the PE investors and public investors, on the same footing. Obviously, from a regulatory standpoint, maybe we get a little bit of a leeway in terms of saying that when you're private, you can have the shroud of secrecy and you can have the shroud of privacy thrown over yourself so that you can build a company. We have used that to the extent that we are permitted. But frankly, if you look at documents that you sign with a PE or a bank, the extent of information they want is far more than what the public wants. So from day one, your disclosure requirements, your MIS requirements, your the information sharing that you do, the transparency that you have is much, much more than being public. I hope you're able to understand. You sign a 1,000-page capital document with your PE guy. So you've got consent rights, you've got negative rights, you've got tag along, drag along. Your IPO document has hardly anything. They're asking you for information, your KRAs and your metrics. So for us, from day one, it has been being ready. We've been supplying the same set of information to the investors who were part of our growth for the first 7 or 8 years or 9 years. And then we started publishing the same set of information to the public. So there is no real change of being public. So I think I'm taking a step back from all that has been discussed for the last 1.5 hours, because I believe being governance is a part of your value. You cannot change that basis the time or space at which you are. Yes, if you look at what's happened in the recent past, you see a lot of news that's happening about governance issues. It started when you're private. It started when you're young. So there are sayings in our own, your mother, your grandmother would have said, learnings that you have when you're young are what continues to your deathbed. So what happens is you have to have the value system integrated into you from the word go, which is what we did. So we said we'll go public. That is part of our vision statement. We went public. After 1 year, we have now come out with our vision statements for the next 10 years. And we have said we'll continue to do what we are good at, which is build business and have returns to the shareholders, and continue to report on that to the public. So yes, people talked about predictability. It's very important. But you need to understand that the world is not going to be, say, who thought Ukraine war would happen, who thought the fuel prices would go up. So there are so many things unknown. You have to build a business which is based on strong value systems, ethics, governance, and which is fundamentally good. If you do this, I don't think you're going to have a problem, Shrija. So I may sound like a philosophy teacher here, but that's what we believe, and that's what we did. So yes, like Rajan said, when we were doing the IPO all by myself at home, all my teammates at home, because we were the first IPO to hit during COVID. Lawyers used to ask questions, we used to give. I wouldn't bother about saying, hey, you know what, SEBI is going to ask me some question, and what happens if I don't have the answer? I'll give them an honest answer, and this is what it is. If it delays the IPO, so be it. But if it hastens the IPO, so be it. So I think a lot of philosophy out here, but that's the truth of an IPO, Shrija, because people have asked us, how did you sell yourself at 166 rupees and today you are at 1,200 or 1,300 or whatever the price? We said, we have a price, we go with bankers, we go with the advice, we know our business. This is a market that we want to do. We want to be here for the long term. We want to build a business. If the investor is going to make money, he is going to be happy with us. And I'll tell you, the outcome has been when we finished our IPO, I had 60,000 retail investors. Today, I have 7 lakh retail investors. Every one of them is, I'm sure, happy being a Happiest Minds investor. How different is he from the PE investor who got his X number of returns? So that's the philosophy that I can put forth here, Shrija.
Thanks for that, Venkatraman, and thanks for putting it out sort of so well that, Shrija, I might sound like a philosopher, but that's really how your organization has been built. And perhaps that could be more intrinsic to you and unique to you and the way you have led the fundamentals of your organization, and perhaps not be emblematic of what we are seeing on the larger capital market side. But you definitely had a great run from 166 a pop listing to 1,000 rupees that you have right now. And that too in a COVID scenario is not a small feat. I also want to come to you now, Chakri. We just heard from both the entrepreneurs right now, Happiest Minds and Latent View technology companies. And one of them also actually sort of went IPO during the COVID scenario. When you look at the larger capital market stack that you're seeing right now, this entire moot conversation, the journey after the finish line, what really are the observations that you can draw in terms of either price volatility, communications to stakeholders, changes in the guidance, and just the sheer fact of this new age entrepreneurs being very open about this quarterly scrutiny? What really is the sense that you get?
Yeah, sure. Yeah, here there are two ways to look at it. One, clearly, is most important that a company's value system, ethics system, governance, and these are all key for long-term sustenance. And so those are kind of the must-have for a successful company to grow and evolve over time. And then you deal with randomness. A good company also deals with randomness. Now, Netflix, 3-4 months ago, its market cap was about $300 billion. ExxonMobil, the oil company, was also about $250 billion. Then, 3-4 months later, Netflix lost a few subscribers. Still an excellently run company. Its market cap has fallen from 300 billion to about 95 billion. That's a 70% drop. They've executed well. They've done all the right things. They've checked all the boxes. There is some growth, slowdown of growth. ExxonMobil, on the other hand, from a $250 billion company, then thanks to the Ukraine-Russia war, its market cap jumped from 250 billion to 350 billion over the space of 3 months. Now, here you have a company now, Netflix, an investor who has invested somewhere from about when it was 300 billion, now needs to wait for the stock to go up or the company's valuation to go up 3 times. The fall was only 70%. It now needs to go up 3 times to go somewhere close to wherever the investment was. Now, that's how brutally things change in a public market, however well a company is run.
Absolutely.
And then you have a company's, now a 90 billion has to do an extra hard work. Now, tomorrow when the company goes out to raise capital, yes, it can cite various reasons for the market fall, but still it is a factor when next time they go out to raise capital. There are certain things which you cannot control, like the Ukraine-Russia war, and there are certain things which is, for example, subscriber growth in the case of Netflix. Not that it can control it. Yes, it can do a good job in attracting more subscribers, but the communication and the active management of that communication in the right way, in the right spirit, also plays a very important role.
Thanks for that, Chakri. That's a very important point. And Venkat, I would like to sort of get your views on this, dealing with randomness. And I think it's amazing how organizations like yours are sort of being built on great and correct values of high ethics, high corporate governance, and treating capital the same, coming from private source or a public source. But this entire attitude towards dealing with randomness, which can actually have very different results for an organization, especially when you've gone public. I mean, you can actually see the market capitalization of some companies being wiped out, 1/3 of it, right? Or perhaps some companies going larger also. So what is this readiness of the CEOs in terms of dealing with randomness, especially publicly listed? And I'm kind of reminded of Nassim Taleb's book here on how to sort of deal with randomness, right?
Sure.
Perhaps the leadership always behaves as if these black swan events never existed, that abnormalities don't exist. And when it hits you in the face is when you realize, oh shit, we could have planned better. So you think that CEOs and the promoters are kind of ready for these abnormalities and randomness? Yeah.
Again, I'll just drop on my experience at Happiest Minds here. We were ready with our enterprise risk position from the word go. If you look at it, we had a succession plan that was put in place for all the senior management. During our roadshow, we shared that with the investors. During our when we were a private company with private equity investors, that's what we had shared with them. This is what we have as a roadmap for our succession plan, because people are the most critical element in an IT services company, and that's backed up. And that's something that was put in place. Exigency plans were put in place. More than that, you had we had what are the risks that we could identify. So if you look at the IPO document, there is a huge section about 30-40 pages where they talk about risk. Cookie cutter approach is what I would say most of the people, they just look at the risks and they just keep knocking it off and say this is what a risk is, and they put it into the document. But we really believed in that even before the document was put. So we had our own risk management plan put in place, try to mitigate the randomness to the extent possible. Now, there are things which are well beyond our control. So if I go back to my Mindtree days, the dot-com bust of 2000, when that happened, we were not ready. 1999 was when Mindtree started, and we were building a company. It was being built on the basis of the successful Cambridge Technology Partners, the Monday Consulting, the Tuesday Consulting, the Scient, Viant. Those were the companies that we were building basis what was in demand at that point in time. 2000 happened, and then the whole thing went bust. And then you know what happened, the global twin towers happened. Things went south even further from there. So having seen this in the past, most of the people in our company, we were willing to put in together a risk management plan and possible mitigation to the extent possible. And we were ready from word go. So that's what I'm saying. The risk management document that you see in our IPO document was there ready from the word go. So getting ready for an IPO is not a part of the journey, but it's something that you have to start thinking from day one. And to me, it's not too difficult because capital, again, is fungible. I hold the capital that I raised from, if it is TCG or if it is the PE funds, the JP Morgans, with the same respect. Banks, the same respect as I'm treating the capital that I raised from public markets. Money is the same, color is green. I cannot treat them differently. If you have that value system, from word go, you will do the right things.
Color of the money is green, does not really matter what source it comes from. And perhaps you also do a mention on dealing with randomness, that the readiness has to start from day one, that you want to be a public company. It just can't be a transition, seeing that there's so much hot liquidity in the market. Let's go out and do an IPO. I want to understand from you, Rajan, what really is your viewpoint, especially on dealing with randomness, and how is leadership aligned for that discussion? Yes.
So just to build on what Venkat said, right? I think as a company, you need to have a very rock solid foundation. And which, again, talking from my own IPO experience, one of the things that came up while we were putting out our DRHP, and the lawyers were really trying hard to dig out if there was any litigation for us, in our entire 15-year-old history. And you'd be surprised that, and this is something that came up from a lot of investors, we had absolutely no litigation at all right through our 15-year-old history. No customer litigation, no employee litigation, no litigation with any government department. So stepping back, this is again, goes on to solidify the way you run your business, right? With the right ethics, right principles, doing the right things, right? Spending on the right things. And therefore, as a company, we always believe that as long as the foundation is correct, right? Even though you may not outpace your competitors, but you're growing in the, in the right direction, as well as doing the right thing.
I think we'll sort of take the discussion forward. It's sort of good to hear from the promoters, and they're talking nice things about the organization in terms of corporate governance, value system. But Chakri, let's talk also about the bad and the ugly part, which comes to the fore. Really, you spoke about one of them is about dealing with randomness, where perhaps we have not necessarily seen leadership in few of the cases not necessarily emerge stronger as it's coming out. What really are the other cases? I mean, corporate governance definitely seems to be one, especially which we're saying with albeit in the larger companies also. So in this entire talk about the journey after the finish line, what are the 5 key things that I were to ask you specifically one has to definitely keep in mind? That the journey has not finished with the IPO, it actually has begun.
Indeed, Shirja, I think the journey does begin after the IPO, because the runway is infinite, depending upon a company's imagination to grow the company, reinvent itself, and reinvent itself over time. If you look at some statistics, if you look at the last, let's say, 10 odd years, some nearly 550 companies. It's good to understand the numbers. We all know the numbers, but with about 550 companies were listed, out of which some 62% of them do not trade anymore. And another 15-20% is actually down about 80% from their listing price. It's only about the 15% which have actually are above their original market price. These are the statistics of Indian IPOs over the last 10 years. Now, this is true across investing because, if you were getting a perfect score always, then there's no such thing as a failure. Everybody is succeeding all the time. So what this tells is basically, once a company reaches an IPO line and thereafter, you've seen only 15% of them actually succeed. So the picking the right company with the right values, with the right business model, and evolving itself over time. Now, Microsoft today is a very different company than what Microsoft set itself out to be several decades ago.
Absolutely.
Reliance Industries was an oil and gas company less than 10 years ago. And today it's a company which is growing in brand new businesses, whether it's telecom or retail, today green energy. And so a company's journey is not constant. They constantly need to reinvent themselves. And I think that reinvention doesn't happen every quarter, doesn't happen every year, but it happens continuously over time. And the public market constantly evaluates, reevaluates when this whole talk about whether a company meet expectations or beat expectations is not really about that. It is about demonstrates a company's ability to control the levers within its business. Yes, there are a certain amount of randomness outside, but outside of the randomness, are they effectively managing the levers to grow faster than their own sector, faster than their own competition? And as technology, business conditions, etc., change, does the company have the ability to continuously reinvent itself over time? That contributes to the longer term success, as we've seen, when less than 15% of them actually succeed in the public space. I think keeping that is an everyday journey. You constantly talk to company CEOs, CFOs, management, customers to see whether this company is making that journey. Xerox is a good example. At one point, it was the market leader. Then new kinds of businesses came in. There was no real need to Xerox a document anymore. The company does not exist in its original form. At one point, it had the major market share. The reason is rest of the competition had died out, had fallen out, or decided not to invest in that business anymore. And today, that company doesn't exist in its original form. We still use the word Xerox as a generic word. So that differentiation is very key in the continuous success of a company once it's public.
That's very well said. About only 15% of companies are those in the entire stack which actually emerge stronger. These are sort of hard-hitting facts. And I completely agree that reinvention is the name of the game. Those organizations which have tried to defend and extend themselves, we have seen the might that they have faced. Look at BlackBerries or Nokia, or some of those organizations so big at one point of time as to where they are now. So I think my last question and concluding remarks really to this panel is one key sort of lesson in terms of the journey after the finish line. What would that really be? I think Chakri has sort of set the stage very correctly, saying that reinvention from where the organization starts to where they are now is completely different. Look at what Microsoft began with. For that matter, Google began with. Google is acquiring a company every week for that matter. But Reliance is right now. Oil is perhaps one of their businesses to the larger ecosystem they want to be. Amazon for that matter. So really, one organization journey after the finish line that we're talking about, one key lesson there. Yeah. Venkat, I'll come on to you and then conclude sort of with Rajan. Yeah.
I'll just build on what Chakri mentioned. If you look at valuation metrics, a large part of your valuation goes into a concept called valuation perpetuity. That's the value of the company beyond, let's say, the 3-year period or a 4-year period. It's a line of sight. How do valuations? So you speak to Damodaran and you read textbooks on how to value. They'll put 30%, 40%, 50% of the value of a company into perpetuity. How much of a time do we spend, the investor or the market spend in understanding what is perpetuity? That's where this 15% of the success rate of companies which continue matter. So if you have your philosophy, if you have a business model, your focus, your KRAs, your numbers, focus, and you know how to deal with randomness, how to deal with change, and those are things which are addressed in the 4-year period that we're talking about. You can, with a certain element of certainty, say that the perpetuity part is also taken care of. And, I hope you're getting what I'm saying. You're leaving 50% of the value of the company beyond a line of sight, and then you don't really know what's going to happen at that point in time. But you can make an assessment of the possibility of success of that perpetuity basis how the company is doing the current and how they're guiding their business for the next 2, 3, or 4 years. So Reliance is now known as a company which will keep reinventing itself. Nokia will reinvent itself. The Unilevers will reinvent itself. Happiest Minds will reinvent itself when the requirement happens. Because next 10 years is going to be very different from the last 5 or even the 10. How ready are you prepared to take that on? Because you are ascribing a large part of the value of the company for how we are going to handle that. So it's an assessment, and that assessment happens basis what we have been discussing all this while. How have you been performing? Are you a growth company? Do you have your values in the right place? Do you take the right decisions on the face of inconsistencies? Are you able to handle inconsistencies? How are you communicating to the market? All those good things we talked about. And obviously the past sessions, are you generating cash? Are you profitable? Those are the key questions that will have to be answered. And this is what you have to focus on life after listing. And just to end, which is why we have in our vision statement for the next 10 years saying that we are setting up a company which will last in perpetuity. So we are trying to address the risk that Chakri just talked about.
Outline. Okay.
That's right.
What about you, Raj? Any concluding thoughts? Then we'll wrap up the panel. Yes.
Yeah. So I know. I mean, Kunal in his earlier session, he spoke about going public as he said that it's almost like a second marriage, right? And that was very interesting. Obviously, the post IPO transaction stage it involves executing the promises and all the business strategies that you would have articulated during the investor roadshows, right? Because you as management, you go through hundreds of these meetings where you keep beating the same thing over and over again, right? You try to articulate what your strategy is going to be, how are you going to grow this company. But post listing, right? I mean, that's the time that you have to not just deliver on those promises, but continuously beat them as well over time, right? As management, again, I think in India, Infosys set the stage by giving out guidances, and analysts on the street continuously expect you to put out guidances, and that's something that you have to again learn to live with, right? In fact, someone interestingly remarked that Infosys had a track record of beating their guidance all the time. So therefore, if they guide the street on say 10% growth, the analyst, when they build their model, will automatically build a 12% growth, right? Because you would expect them to beat their guidance. So that's the sort of benchmark that you set. So obviously, there are expectations that are already there that you would have set. You have to continuously try to beat them. This stage typically is obviously the point post listing is a very long period of time. We spoke about a 5-year, 10-year period where you have to continuously deliver. But as stressful as this is to the management needs to they need to learn to deal with stock price fluctuations, right? The stock price will go up or go down. But what as management you need to focus on the trying to execute the narrative that you established before going public, and control what you can control, and things that are outside your purview, you don't bother about them. Just quietly sit in your corner and execute the business strategy that you put out. And as long as you're able to do that, I think the street will respect that, and it will reflect in the stock price.
Thanks for that, Rajan, Chakri, and Venkataraman. We had a very meaningful discussion, I must say, journey after the finish line. We began the conversation on sort of really beginning and sort of setting the context for how organizations should be built on great corporate governance, values, ethics system, building for perpetuity, and how leaders of tomorrow also have to deal with randomness. And very important point with reinvention, the name of the game. I think consensus of what I'm drawing really is that boring is the new sexy, really. I mean, you've got to do the boring stuff and do it repeatedly and every day, which is non-glamorous, focus on the growth numbers, articulating your strategy, and really putting your team well knit and together. And I think some of the founders and perhaps the new age ones who perhaps have fallen more for the PR statement or making that large announcement on the IPO bell have had their lessons learned. But really it's about doing the boring stuff and doing it day in and day out when you have gone for the public market float. Till time I see you next, goodbye and good luck. And thank you for joining in, Venkatraman, Chakri, and Rajan. It was really wonderful talking to all of you. Bye-bye.